Let's now understand more about Article 10 dividend. Now, what can happen is that there may be a company in the state of source where the shareholding, either entirely or part, may be owned by a company or another individual who's a resident of the other contracting state. Let's call that state a state R. End of the day, an investor makes the investment for the purpose of earning money out of those investment or capital appreciation. Generally, the way it works is that the profits which are earned by the company are taxed in their own hands, and then whatever remains after paying taxes on those profit, that is distributed to the shareholders as dividend. The question that comes up is how those dividends should be taxed. And is it a double taxation? Yes, of course, there is a two-layer of taxation when the business operations are run through companies. But the question is how this dividend has to be taxed. And this is something that is dealt with in Article 10 dividend, which is going to be something that we are going to look at in this presentation. Now, before that, we get into the specific provisions of Article 10. It is also important to understand what exactly is dividend. Dividend is nothing but the distribution of profits by companies which are limited by shares or by limited liability company or by limited partnerships with shares. Now, the difference here is that these are companies. Here we are talking about limited partnerships. In some part of the world, this concept may not exist, or other joint stock companies. Now, other joint stock companies in some OECD countries are the countries which have separate legal entity separate from the shareholders. What happens is when we talk about partnerships as a general concept, the profits of partnership may be taxed in the hands of partners, where these partnerships are treated as fiscally transparent. In such cases, what happens is that the profits of the partnership are actually the profits of the partners. In other part of the world, something like in India, that is not the case because the partnerships are taxed on their own profits, and these profits, after they are taxed in the hands of the partnership, are exempt in the hands of the partners. But that may not be true in some of the other parts of the world. So wherever the profits of partnership are taxed in the hands of the partner, they are treated as fiscally transparent. However, this is not the case in case of companies. In case of companies, the profit of the company are not the profit of the shareholder, because company is a separate jurisdictional entity and is not a fiscally transparent entity. Therefore, the dividend or the money remaining after payment of taxes is something which is taxed in the hands of the shareholder. So let's look at a typical case where there is a company in the state of source. 100% ownership of this company is with another foreign company, which is a residence of state of residence. And let's assume there is a tax treaty between these two. The typical issue that would arise in this case is, would this dividend be taxed only in the source state, that is state S? Would it be taxed in the state of residence only, which is state R? Does it has an exclusive right to tax such dividend? Or will both the state have the right to tax such dividend? The next question is, what exactly is the meaning of dividend? We briefly saw what is the meaning of dividend, but in a greater detail, is it different from common parlance? And the last and the most important question is it that the dividend which has been paid should alone be taxed, or even the dividend that has been declared but is remaining unpaid should be taxed as well? In other words, will the dividend be taxed on a payment basis, or will it be taxed on an accrual basis? This is another question that needs to be answered. And the answer to all these questions is something that lies within Article 10, which we are going to look now. So again, the key aspect is what? Whether dividend paid should be taxed, or whether dividend declared and remaining unpaid should be taxed, what is covered within the meaning of dividend, and what if the non-resident has a permanent establishment in the source state? Will it impact the taxation of dividend? Something that we are going to discuss in the first part of this presentation. The answer to all these questions are there in the next slides. So let's go through them.
Thanks for watching this video on international tax. If you want to enhance your career in international tax and learn everything about how to interpret various articles of a tax treaty, learn about BEPS, global minimum tax, and similar concept, you can subscribe to our online course on international taxation, whose link is given in the description below. If you have queries, you can reach out to us. Look forward to having you on board with us for our course.